Welcome back to the Profit Boss podcast. Today I have a FAQ episode where I have searched through my email inbox and looked at the questions that I get asked on a daily basis and picked out those that I find are quite frequent. Truthfully, my main job is answering people's questions, so I have been always flooded with various different questions that pop up along the business journey, and these are definitely the ones I get asked quite frequently. First of all, if I'm a sole trader, do I need to do an individual tax return and a business tax return? So this is one I get pretty frequently when someone is operating their business as a sole trader, and the answer is no. So as a sole trader, you are the business. It's not separate from you. And so the tax office only needs one tax return, and it's all done together on your personal tax return is where you also add your business information. And yeah, I help lots of sole traders with doing that at year end. Another question I get asked is, if I'm new to business, should I be having a money meeting every week or month? And if I am doing that, what should I be looking at and why? And my answer is 100% yes. And this is not only for new business owners. So if you've been in business for 4 years and you've never done this, well, it means you're probably doing really well. So congrats if you haven't had to, if you've got this far and not intentionally sat down and done this. But truthfully, it will pay dividends to sit down and look at your numbers on a frequent basis. When you are doing this, some of the things that you should be doing are, one, calculating your tax savings. Now, your accountant will tell you how much to put aside, whether it's a percent basis or if it's a set amount per week, or maybe you have a practice of just prepaying it straight to the ATO. So every week you're just going to pay $500 to the ATO knowing that that goes towards your future BAS or tax bill. Either way, once a week, you want to be looking at that and doing that on a recurring basis. Number two, you want to be looking at incomings in the next sort of week to month and also outgoings so that you can reasonably make a forecast of what you expect your cash flow to look like. And this would be especially important if you have maybe like a pretty big bill coming up. I'm thinking of like a tradie client where they have their end of month materials bill, so that can add up. It could be, 5 to 20 grand that they've got to pay at the end of the month. So if you're not sort of looking ahead of, well, will those invoices be paid by then and will I have the cash that I need to pay that? Then you could get to the day that bill's due and not have that money sitting there, or be surprised by the fact that you don't have it there. So if you're not sitting down to sort of look at that cash flow forecast of what's coming up, you might be left with some surprises. This money meeting should also look like getting your records up to date. So if you do your own bookkeeping, you'll be looking at your receipts, putting them in your filing system. Maybe you're reconciling Xero or updating your spreadsheet. Maybe you're paying staff because you have staff to pay each week. So that is all part of this process that should be in your calendar. Also, I think something that often small business owners neglect is following up invoices. So if you have payment terms of what you've asked someone to pay you within, stick to these, be strict on them. You're owed that money. So if they haven't paid within the 7 days you asked for, day 8, you're sending them an overdue payment reminder. And by doing this on a frequent basis, you are setting that habit and practice and expectation that I will do work for you as long as I'm getting paid on time and in full. And things like Xero actually have automatic payment reminders that can go out. So you can absolutely automate this step. But yeah, it is also important that especially those really long overdue invoices that you're taking the time to send those clients an email, follow them up, give them a call. I always say, like, if you don't want to be the person behind an overdue invoice because maybe you're the only person in your business, set up like an admin @ email address. So the person receiving it doesn't associate you with also doing the work for them, but also being that person to follow them up for money. Sometimes people can be a bit embarrassed or they actually don't know how they're going to pay for that invoice. At the end of the day, they've engaged you to do the service or provide the product. So follow them up for the money. They've engaged you to do that for them, but you don't have to do it under your name. You could, set up an admin email, or sometimes they say like a Karen at email if you want to, be a bit funny. And something else you could also look at is reflecting on some past projects or jobs you've done to check what profit you've made on them. So let's say you created a website for someone and you had all that project finished up and you know exactly what you made in sales from it. You then want to also look at what costs it costs you to do that service. And this would be in the form of maybe some contractors you've had to do the graphics, your time. So put a dollar value on your time that it's taken to do that job, and then make a reasonable allocation of what your total overhead costs of the business would be towards that job. Like maybe you say, my overheads to run this business are 20 grand a year, and for each job I'd say that 5% of that per year goes to each job. That's just like a rough example. And then see what, if you had your total income from that website minus the expenses that you incurred to be able to deliver that, what are you left with? Is that enough? Do you need to charge more? Do you need to spend less time so it's more efficient and you do it in a quicker time frame so you've got more time to work on other billable work? Think about if that is providing the profit on that project or job that you would have hoped for. And if not, why not? So that's sort of just a sample of what you could cover in a recurring money meeting. But at the end of the day, you should be doing it, and it should be in your calendar. And no, it's not the most fun job, but it is important. Another question I often get asked is, do I have to pay super if I'm a business owner? And the answer is, it depends. So when we pay a staff member, there is compulsory super on top of that. There's no rules around that. That is compulsory. So you've got to pay their wage plus super. And really that's the government's intention behind allowing people to retire one day. So money in super is locked away, intended for retirement. And it's a scheme to hopefully allow us all to one day put our feet up and go on holidays and use our super to live the rest of our lives out with. However, if you're a business owner and depending on the structure you're in, this may not be compulsory from a taxation and government perspective. For example, if you're a sole trader, because you are the business, you can't pay yourself a wage, which means there's no compulsory super. However, all super contributions you do make as a sole trader are tax deductible. And if you think about that, that's money you're putting into super, so it's your money, and you're putting it into super, let's say it's 5 grand, you get a tax deduction for that 5 grand with that money actually being yours still because it's in your super fund, and it'll make you money over the next 20, 30, 40 years, and you'll get it again when you retire. If you're a company and you pay yourself a wage from that company, then that wage you pay yourself will have compulsory super on top. So all of a sudden, even though as a sole trader, it's not compulsory, once you're paying yourself a wage from the company, it is. And so that's a really good example of why when someone asks me this question, my answer is, it depends. So I'd say if you want to know the nitty-gritty of this for your business, then reach out to your accountant to find out what super contributions for yourself mean as a business owner. Another question along the lines of being a company that I come across is, what happens if I take money out of my company and it's not taken as a wage? And so, as you may recall from prior episodes in Australia, you can run a business from one of 4 entity structures. So you can be a sole trader, which is when you are the business. You can be a company, which is a separate legal entity in Australia, so it is separate from yourself. And the other 2 options are something called a family trust or a partnership. And focusing on that company structure, because I would say 95% of my small business clients are structured as a company or a sole trader, so one or the other. But if you're not a sole trader, my business clients would be a company. That is what's most popular because of the tax rates and different concessions we get in that entity. I would say once you're in that company structure, it's important to understand that we can't just rip money out of the company and pay no tax on that. And so a company, like I said, is a separate legal entity. It has its own ABN, it has its own bank account, it has its own tax obligations. And if you're not taking that money out to pay, when I say you're taking this money out, you're taking it out for your rent, for your holiday savings, for your personal bills, to pay for vet bills, to pay for school fees, to pay for your car running costs if it's not already being paid by the business. So you're taking it out because you need it. If you're not taking it as a wage, it's something called a director's loan or a shareholder's loan. And that money sits on the company's books as money you owe back to the company at some stage. And so I always like to caution that if you're not paying it as a wage, there will be future tax implications that could come up down the track. So it's really important that if you're in a company structure, you're talking to your accountant about how you're paying yourself out of the company and what's going to look best for your unique situation. Again, along the lines of this word company, I have my final FAQ, which is I am often asked, when should I go to company? And it'll be my sole trader business clients that are asking me this. And again, I know I sound like a broken record. Everyone's situations are quite unique, so this is a personalised conversation that I have. But the considerations and questions I ask in this situation is, what sort of profit are we making at the moment? And how does that compare from a tax perspective with making that profit in a company? So if you're a sole trader, you're paying the personal individual marginal tax rates, which means the more money you earn in those brackets, the higher rate of tax you pay on your profit. So for example, up to $45,000, you're sort of paying 19 cents to the dollar versus, let's say you made a $200,000 profit as a sole trader, you could be paying up to 45% to the dollar. So it's important to compare, if I was earning this profit as a sole trader, how much tax would I pay versus if I was making this profit as a company? And could I pay less tax if I was a company? Because a company pays a flat rate of 25% on its profit. So that's always my first point of call, because it could be from a tax perspective that we go down the track of changing to company. But also coming back to the type of structures they are in themselves. As a sole trader, you are the business, so you've got no asset protection. If the business is held liable for anything, then you are liable as well personally, versus a company, separate legal entity, the company's held liable for something that may have gone wrong in business. And so sometimes, as soon as you might not be making a profit that warrants getting a tax benefit from a company, but you may have, let's say, 10 staff. And in that situation, you're in a pretty high risk factor when it comes to something maybe going wrong. Like, if a staff slips over or they're out driving when they're at work, like things can go wrong. And then as a sole trader, you'd be held personally liable for that. Whereas if you have staff in a company structure, you're providing a asset protection mechanism by trading your business through that structure. So I'd probably say that they're my two main factors that I talk through with a client of, do I go company? So it'd be whether there's a tax benefit and whether there's current staff or potentially going to be staff. But other things we talk about are you going to need finance soon? Because a bank may not favour a company, or they may favour a company depending on your situation. Are you going to sell your business soon? Like, that might mean that we restructure the whole thing altogether and go down the track of using a trust, because we get better capital gains tax concessions when you sell that business. I know that's a lot of accounting lingo, but it is just to highlight that your goals and where you're at in business and where you want to go all come into this conversation of, should I change to company? I know recently I spoke to a client who sort of must have been talking to some mates and thought, I think my photography business should be a company. They're all companies. My mates are all companies. They're small business owners. I should be one too. And we went through all these factors, and I said, where do you see yourself in a year's time? And he said, in Europe, I'm going on a holiday. I'm going to go and I don't know when I'll come back. And I was like, companies are so expensive. So like minimum it'll cost $600 a year just to keep it open. And then as soon as you have even $1 of trading in there, you've got to engage an accountant to do financial statements and a company tax return. And you've got to report to ASIC each year in terms of like who's director, what's the company address. All this stuff costs money. And also when you go to wind up your business, if you're in a company, you can't just walk away one day and close it down. There is actually, because it's a legal entity, implications of just closing it down. We've got to get it in the right position to do that. And so if in the short term you're like, well, I'm probably not going to have a business in a year, then it's probably not the best choice to go full blown into company. Keep it sole trader, keep it simple. You can wind up an ABN within a day, you know. So your goals really do matter, and those conversations with your advisor will shape what the best advice is for you. And so that covers my FAQs that I found in my inbox. I am always happy to answer questions. So if you're a current client or you would like to be a client, reach out, ask me a question. Also, if there's anything you want me to specifically cover in this podcast, I'm all ears for feedback and comments. Thank you so much for listening. I really appreciate it, and I will talk to you again soon.